Listen to me, because what I'm about to tell you is the difference between keeping your hard-earned money and handing it right back to the IRS. You've worked 40 years, you've paid into the system, and you've finally reached the finish line. You think your Social Security check is yours, free and clear. But then, tax season rolls around and you realize you owe the government money on the very benefit they just gave you. It feels like a betrayal, doesn't it? It feels like they are moving the goalposts right when you've stopped running. The fear I hear from so many of you is that you're going to outlive your money. And that fear is real. But the biggest threat to your retirement nest egg isn't always the stock market. Sometimes, it's a little-known calculation called provisional income. If you don't understand this number, you are flying blind. You might be making withdrawals from your 401k or taking a part-time job thinking you're getting ahead, only to find out you've triggered a tax trap that eats up 50% or even 85% of your Social Security benefits. So, what is it? What is this provisional income? The IRS doesn't just look at your adjusted gross income. No, they have their own special math for retirees. To find your provisional income, you take your adjusted gross income, that's your pensions, your IRA withdrawals, your wages, and then you add in any tax-exempt interest, like those municipal bonds you thought were tax-free. Are they tax-free? For federal income tax, yes. For calculating your Social Security tax? Absolutely not. Then, and this is the key, you add in exactly 50% of your Social Security benefits. That total is your provisional income. That is the number that determines your fate. Now, why does this matter? Because the thresholds for taxing that income haven't been adjusted for inflation since 1984. Can you believe that? In 1984, a gallon of gas was about $1.10. The world has changed, but these tax brackets haven't moved an inch, which means more and more of you are falling into this trap every single year. If you are filing individually and your provisional income is between $25,000 and $34,000, up to 50% of your benefits can be taxed. If you go over $34,000, up to 85% of your benefits are subject to income tax. If you are married filing jointly, the range is $32,000 to $44,000 for the 50% bracket. Anything over $44,000, and you are in the 85% zone. Do you see the problem? It is so easy to hit these numbers. If you and your spouse are receiving $40,000 a year in Social Security, right there, $20,000 is already counting toward your provisional income. If you take out just $25,000 from your traditional IRA to pay for a new roof or a grandkid's tuition, you have just crossed that $44,000 threshold. You didn't just pay tax on the IRA withdrawal, you triggered a tax on your Social Security that wasn't there before. It's a double whammy. You're asking yourself, Susie, how do I stop this? How do I keep the IRS out of my Social Security? You have to be smart. You have to be strategic. The first actionable takeaway is this: the Roth IRA is your best friend. Money coming out of a Roth IRA does not count toward your provisional income. It is invisible to this calculation. If you are still working or in the early years of retirement, look into Roth conversions. Pay the tax now, while you know what the rates are, so that later in life, your income doesn't trigger the Social Security tax trap. Second, look at your cash flow. If you need extra money, can you take it from a standard savings account or a brokerage account where you're only paying capital gains on the growth, rather than full income tax on the whole withdrawal? Every dollar you take from a traditional 401k or IRA is a dollar that pushes you closer to that 85% tax hit. Third, be very careful with municipal bonds. People love them because they say tax-free, but as I just told you, they are not free when it comes to the provisional income formula. If you are right on the edge of a threshold, those tax-free bonds could be the very thing that makes your Social Security taxable. You must stand in your truth. You must look at your tax return from last year, find your AGI, add back that tax-exempt interest, and add half of your Social Security. If you are over those limits, you need a plan. Don't wait until April 15th to realize you've made a mistake. You have the power to control your taxes, but only if you understand the rules of the game. Get your documents out, do the math, and protect your retirement. Because if you don't take care of your money, who will?